How much is corporate peace really worth? Sometimes it comes down to a single figure. For the Lopez family, that number might be 81 pesos per share, the price that could transform First Gen's future and reshape Philippine infrastructure altogether. At 81 pesos, First Gen would command an equity value of around 291 billion pesos, about 4.75 billion US dollars. This price reflects not just its recent market performance, but its hidden value. A significant stake in Energy Development Corporation, diversified gas and hydro assets, substantial pumped storage investments, and a remarkably liquid parent balance sheet. The arithmetic is straightforward: 3.597 billion outstanding shares, each representing a slice of the country's energy backbone. But a deal of this scale requires more than just numbers on a page. The most likely acquirer isn't a foreign giant, but Enrique Razon Jr.'s Prime Infrastructure, already intertwined with First Gen through joint ventures in gas and hydro. Their partnership is far from new. Prime Infra acquired 60% of First Gen's gas business and, in turn, welcomed First Gen as an investor in its pumped storage projects. As Prime Infra expands into international waters, the alliance deepens. A full buyout at 81 pesos per share is ambitious but not implausible. Purchasing the entire company would mean a bill of 291 billion pesos. Yet, acquiring just the Lopez block, about 67.84%, would cost approximately 197.6 billion pesos, or roughly 3.2 billion US dollars at current exchange rates. Given KKR's 19.9% stake and an active public float, any acquisition would demand equitable treatment across all shareholders. For KKR, which entered between 22 pesos and 33 pesos per share, this offer represents a considerable premium, but also invites scrutiny on whether it fully values First Gen's diversified assets. The resources to fund such an endeavor are formidable, but so is Razon's standing. With a net worth eclipsing 20 billion US dollars and a portfolio extending from ports to water, power, and global energy, Prime Infra brings institutional credibility and financial muscle. Still, this is far more than a personal check. It would necessitate structured financing, debt, co-investments, and possibly participation from international partners. The acquisition price marks only the beginning of a complex financing journey that extends to consolidated borrowings and new capital obligations. Beyond financial engineering, the acquisition opens a strategic opportunity. Prime Infra, still privately held, could use First Gen's public listing as a platform, merging its own assets with First Gen's to create a new kind of infrastructure powerhouse. This backdoor listing could unite gas portfolios, hydropower, renewables, water, and international assets under one listed entity. For public investors, it means access to a diversified, Razon-led conglomerate. For Prime Infra, immediate governance and a robust shareholder base. Structuring such a transformation, however, is anything but simple. Regulatory scrutiny will be intense. Asset injections would require independent valuations, board and shareholder approval, and stringent safeguards to protect minority interests. KKR's stance will be pivotal, whether they choose to exit, stay as a cornerstone investor, or roll their stake into the enlarged platform. But why would the Lopez family sell now? The answer lies in crisis as much as opportunity. An ongoing family dispute has spilled into public view, delaying shareholder meetings and raising governance concerns. With control of First Gen fragmented through corporate layers, the risk extends beyond family members. Minority shareholders, institutions, and pension funds all share the burden. Selling First Gen would shift the conversation from contested control to the unambiguous allocation of cash. For the Lopezes, this influx of capital could be transformative. ABS-CBN, their flagship media company, faces mounting debt and ongoing operating losses. With proceeds from a first-gen sale, the family could recapitalize ABS-CBN, refinance debt, and fund a strategic pivot to digital, content, and live entertainment, free from the complications of using public company resources for family interests. For Enrique Razon and Prime Infra, the deal offers a rare chance to do in energy what ICTSI accomplished in ports: build a Philippine-led infrastructure titan with global reach. For minority shareholders, the premium offers a rare, clean exit at tangible value. And, perhaps most importantly, for the Lopez family, it provides the means to settle internal disputes, redistribute wealth from the pyramid of control, and secure the future of their broader business empire. Yet, the risks remain formidable: complex financing, regulatory hurdles, asset valuations, and the ever-present tension of aligning all stakeholders. Still, the alternative is continued uncertainty, value erosion, and a family conflict that increasingly threatens more than just reputation. A 81 peso offer could represent more than a buyout price. It could be the cost of peace, the value of transformation, and the rare alignment of interests capable of reshaping both Philippine infrastructure and media landscapes for years to come.